I have a few questions. I would really like to know, how are we going to get out of the problems that we have in the office sector in the US? I'd really like to know how we're going to solve the housing crisis. I'd like to know if we're going to see an escalating environment of trade tensions globally getting in the way of cross-border investing. I want to know, what do you do when you can't count on interest rates dropping every year or so, allowing us to financially engineer our way to the best possible returns? That's what we did for the last 20 years. What are we going to do now? Now, I know it's difficult to have answers to any of these questions in an uncertain environment, but it doesn't hurt to ask.
You are listening to the AFIRE podcast, real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
I'm talking right now with Spencer Levy. He's the global client strategist and senior economic advisor for CBRE, and someone who's never afraid to tell you what he thinks. So right now we're trying to figure out, in 2025, where are those surprises going to be? What are those things that are going to hit us upside the head as we are executing our institutional investment strategy in 2025? Spencer, what do you think?
I think the big thing is that for the last 10 years, a lot of people in our business did a lot of successful, profitable deals because cap rates were compressing.
Right.
Cap rates have now expanded, and they're unlikely to come down as quickly or as much as we think. So next year, and probably for the next several years, we're going to see who are the really good real estate operators and who are the people that were benefiting from financial cap rate compression. So I think 2025 is going to be the year of the operator. And going beyond that, you're going to see real estate, maybe for the next 5 years, go back to old school, because real estate used to be slow and steady winning the race. Maybe we're back to the future.
So 2025, I expect then, based on what you've just said, that we're going to see a lot less financial engineering, perhaps, than we've seen in the past, and a lot more, getting our hands dirty.
I think that's 100% correct. And it's going to be much more a market and, better stated, submarket selection game than it is going to be an asset class selection game. There are periods of time where market matters more and asset class matters more. And of course, you're still going to do better in multifamily and industrial than you are perhaps in office. Mm-hmm. But there's going to be some submarkets where office is going to be the outperformer. People often throw office under the bus. I mean, all the headlines in the papers do. Wrong answer. Take a look at today's New York Post. New York is going to have a shortage of office space by 2027. And the shortage is already there today if you're a large block user, if you're in the right sub-market. So sub-market selection, operation in those sub-markets, those are going to be the outperformers.
So office is going to surprise us in 2025. Where are some other kind of conventional no-brainer thinking around, well, you won't lose money on data centers, or, there's no shortage of demand for housing? What is it that's going, beneath those headlines that might surprise us in terms of asset types that maybe we need to be aware of, beyond just office is not dead yet? In fact, office may very well be a good investment for the next 10 years.
So, Gunnar, as we've been friends for a long time, I'm not shy about when I get it right. I'm not shy when I get it wrong. I got it wrong on inflation. A lot of people got it wrong on inflation, where COVID came out of, nowhere, and hopefully never comes again. I thought inflation would be lower forever. Wrong answer. But I also thought 10 years ago that open air retail was the most undervalued asset class. And with the exception of data centers, which have shot past it in terms of getting higher values, I'm still correct on open air retail being undervalued. And the reason why open air retail is undervalued is we're not building any more of it, or we're building very little of it. The replacement cost is 25 to 50% above what it exists today. Consumers still want to spend. And when you see a store closure, like a Bed Bath & Beyond, many of my operators were jumping for joy because they can cut up the box and make 3 times the rent for the smaller boxes. So a lot of the disfavored asset classes, like open air retail, like office today, is where that magical alpha thing exists.
What are you concerned about that people aren't paying enough attention to? What do you think would be a risk in 2025 that maybe has been underappreciated in the last year or two, or is underappreciated in a lot of people's pro formas for the next year or two?
I think the two groups that don't get enough love out there, and everybody needs love once in a while, Gunnar, are appraisers and the regulators. Two groups that people typically are saying, "Oh, the enemy. That appraiser did my appraisal too low, and these regulators are being too tough." I mean, those are what you hear 99% of the time.
Right.
Well, guess who saved the market the last 2.5 years? The appraisers and the regulators. Because the appraisers have an MAI process that allowed them to slowly ratchet down the value of bad assets, notably office buildings, so that banks could increase their capital base so that they could survive the fall off in value. And you know who let them do that? The regulators. And so the same people that you're throwing mud at, give them a hug next time you see him or her. And the point is, the big risk factor in the next year is if interest rates stay higher than we expect. And unfortunately, our current model is that interest rates are going to stay higher for a lot longer. Are the regulators going to turn tail and say, you know what, we're going to change our tenor now? We're now going to be allowing more of these banks to fail. That to me is a much bigger risk factor. Now, the free market capitalist in me says, well, we're back to the RTC days and let's liquidate. And that's a good thing. So there are those that would say that's a good thing to have a market clearing event like that. But that would also lead to a harder landing. And that harder landing will have unintended side effects as it relates to fall off in demand, though it would have an added benefit, so to speak, of interest rates coming down faster.
How likely do you think that is?
I think it's unlikely. Again, I'm not going to speak for the Trump administration, but if there's any scorecard that matters most to this administration, I would say it's the overall health and stability of the economy. While they want to grow, and a new Treasury Secretary has his plan 3-3-3, and what this 3-3-3 really means is 3% growth, 3% deficits. I don't even remember what the other 3 is, but let's just go with 3 and 3. That would be a great thing, but you can only get there if the economy is growing and you don't have a massive calamity in a segment of the economy as large and as important as real estate.
If you had only one investment to make in 2025 in real estate, what would it be?
I would be backing up the truck on putting my shovel in the ground on as much housing as I can do, from luxury down to capital A affordable. This unit shortage of 7 million or more units isn't going away ever. And the reason why it's never going away ever is because even if interest rates come down, it's going to take years. And you know how many people out there have mortgages under 3%? I do this one of these hand-raising things in all my prezos. Everybody, not everybody, a lot of people.
Mm-hmm.
They're not selling their house. So this housing shortage is going to last a decade or longer. And we need housing. And so people say, oh, I can't get my 6.5%, 6% yield to cost. I need to put the shovel in the ground. Well, you can't. But you know who's still putting the shovel in the ground? High net worth individuals who have a lower cost of capital and a longer time horizon. Once again, if you have a lower cost of capital, longer time horizon, this stuff makes all the sense in the world. It's the institutions that still need to get these higher returns on capital that are sitting on their hands. And I think they're going to regret it, because I think on the exit for many of these multifamily and other forms of housing, you are going to see more cap rate compression on the back end when you're the only game in town, when you are the only new product. And I would add one other element to that. You are the most resilient product, because more of my clients now are taking environmental risk into consideration, not only in terms of where they're picking to build, but how they build. And they're putting more cost up front to make that building more resilient. Once again, who was at the forefront of that? High net worth individuals, not institutions, because it's hard to pro forma. If I put that extra dollar into resiliency, will I get it on the back end? And I can't even tell you with certainty on this podcast, you're going to get it on the back end.
Right.
What I am here to tell you is that the big problem of property and casualty insurance, while it did get a little bit better this year, it was catastrophic over the last 5 years of going up 3, 4, 500% in some markets. You're going to be protecting yourself for the long term on property and casualty. You'll benefit from it on insurance and a lower cap rate on the back end. So it makes sense to make those changes up front today. But the only people who have the cost of capital to do it typically are high net worth individuals.
Longer time horizon, more patience, more operations, operational excellence seem to be the bywords. And I'm not hearing you say a better engineered capital stack.
No, that to me is not going to get you to alpha. That's not, because the cost of capital is going to stay relatively high to where it was over the last decade for the next several years, you got to find another way to get there.
Well, thank you for your insights, Spencer. I think it's going to be an interesting ride in 2025, and I would certainly advise anyone who's trying to figure out the year ahead to make sure you give Spencer a call.
Thank you, Gunnar.
You have been listening to the AFIRE podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. AFIRE is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though AFIRE is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of AFIRE.